All right. Um, and welcome. I'm here today with Paul. Maybe let's start with your introduction. What is your circle of competence?
Well, my career was primarily as a professional investor. And so, yeah, that's sort of my area of expertise, I would say. But then over the years, um, as I was investing, at first I was sort of naive about how the monetary system worked. I was naive about economics. I never really studied
To ja już
economics.
nagrywam jak coś.
But then I started becoming increasingly frustrated at how
Mhm.
policymakers, and in particular central banks, were distorting the price discovery mechanism of capital markets, distorting, as Jim Grant would tell you, the most
Mhm.
important price in the economy, which is the interest rate. And and we could talk about that. But then as a result of that, starting at about 2007,
Mhm.
2008, I started studying economics. And so, but it's been in my part time, but that's all pretty much all I've read ever since, reading the different schools of thought. Because as
Mhm.
you know, in economics, it's not a hard science like
Yeah.
chemistry or physics. It's not a
Mhm.
natural science, it's a social
Mhm.
science because it's based on human actions. So there are different schools of thought with respect to how an economy really works, and you end up with normative economics, economics as or economic laws as people would want them to be rather than as they are, because economic laws can be very inconvenient. So it's a long way of saying that I do think I have some competence in the area of economics,
That's
but I'm a self-taught economist, so I'm not an economist. I'm not a trained economist, so I must
Mhm.
caution people on that. It's more about common sense, if you will.
Mhm. And probably it's similar in investing. While you said economics was more like um, heart than brain, not so much mathematics. The
Mhm.
finance, on the other hand, sometimes I feel like there's too much mathematics and they are really trying to simplify something into a formula. And in reality, the market often deviates from the academic theories in finance. What do you think about that?
Oh, yeah, no, absolutely. I think some people call it physics envy or natural science envy, where economists, they want to solve for problems the same way physicists do or chemists do and whatnot. And you can't put um, human action, desires and wants into formulas and numbers and things like this. And it's, it's often, I mean, some of these, when you see some of these equations that they come up with, they're so incredibly complex
Mm-hmm,
that
mm-hmm.
it's almost impossible to follow unless you're like a math genius. And I
Yeah.
think that's the point. And many economists will tell you that uh, the general theory written by John Maynard Keynes is written in
Mm-hmm.
that sort of way. It's almost
It,
impossible to understand. I mean, I've read it, but it's hard to get anything out of it. And then when I read other critiques of it, they're saying exactly the same thing. It's almost like Keynes is deliberately trying to be confusing and
mm-hmm,
contradictory and use big words when small words would have sufficed and stuff like that. It's not to say that everything in the
mm,
general theory is terrible or wrong, although famed economic journalist Henry Hazlitt, if your listeners haven't ever read any of him, they should read some of his stuff.
what is the best
He,
book to start with from him?
so his most famous book, I think, is called Economics in One Lesson.
Mm-hmm,
And the beauty of it, he's such an amazing writer, and it's a short book, and it's all common sense, and you will love it. He's got a number of books, and the Henry Hazlitt used to say about the general theory that much of what's original in the general theory is not true, and much of what is true is not original. And so it's really hard to know what was motivating Keynes. Again, I'm not an expert on the subject. It's just from reading all kinds of stuff on it over the years. Is that, yeah, it was, you know, again, almost reverse engineering. How can we justify government deficits,
Mm-hmm.
debt, increasing the money supply, and sort of reverse engineering to a theory to justify all that? That's just sort of my own opinion. Um, but uh, but yeah, so yeah, you're right. I mean, these complicated formulas and stuff. It,
Mm-hmm.
you mathematics is about. I mean, economics really is about common sense, human actions, not kidding yourself into believing that you can get something for nothing. You cannot. If you take out more from
Mm-hmm.
the system than you put in, it's coming at somebody else's expense. You just can't see where it's coming from.
Mm-hmm.
And
Mm-hmm.
you know,
Exactly, exactly. Sometimes there's hidden cost, like for instance with the oil and gas industry, that over the long term it pollutes the environment. It is
yeah,
seen more in the countries that are producers like China or India, where it is hazardous to live in those environments, breathing in all of those fumes. But
yeah,
also from my own personal experience, if people tend to try and manipulate the market in their favor in order to get a profit without providing a good service or a good product, basically, you can call it stealing a little bit, then over the
yeah,
long term, also it doesn't pay out that well. This is just sometimes a risk premium. If the clients aren't happy, they are not going to come back. You are building a brand if you want it or not. In this case, a negative one. And
yeah,
of course, if you are doing something illegal, it might pay well at first, but after you get caught, the law works in a way that you shouldn't profit off of a crime. Of course, it doesn't always look like this, and there are cheeky ways to work around it. But yeah, and you talked about the monetary policy. I wanted to ask you, how does the central bank manipulate the interest rate, and how does it affect the economy and everyday person?
sure. So, in terms of exactly how they manipulate interest rates, now I will say that, maybe back up a second. You're saying when people
Mm-hmm,
are
mm-hmm,
benefit at the expense of somebody else by doing something illegal. Yes, that's true. But my book is about how people are benefiting at other people's expense and not breaking any laws of any kind. It's the laws that are flawed. The rules are what are flawed that enable and
mm-hmm, mm-hmm,
allow certain part of the population to gain enormously at the expense of the broader population.
mm-hmm,
So we can talk about that later. So in terms of how interest rates are set, so the central bank, I mean, it's changed over the years since the great financial crisis. Um, but effectively, the central banks will affect short-term interest rates
mm-hmm,
by printing money and buying assets. And now, the distorting short-term interest rates also has an impact on longer-term interest rates, also has an impact on 10-year interest rates. And so, and that's sort of what investors are assuming the central bank is how they're going to set short-term interest rates over the next 10 years. And even just, empirically, you can see it. If you put a long-term chart of the Fed funds rate and the 10-year US Treasury rate, it's a really tight correlation. And so the central banks do impact longer term interest rates indirectly
mm-hmm,
via this method. They impact longer term interest rates directly through quantitative easing, where they print trillions of dollars and buy 10-year US Treasury bonds. They impact the 30-year fixed mortgage rate in the US when they buy trillions of dollars of mortgage-backed securities, just like Donald Trump has now instructed the GSEs, or Fannie Mae and Freddie Mac, to go out and buy $200 billion worth of mortgage-backed securities. Now, the goal, or the said goal, is to make housing more affordable. No, this makes mortgage payments more affordable in the short term. It results in higher house prices and more housing unaffordability in the long term. So, I mean, there are lots of other things within interest rates, but again, I'm not an expert in the actual mechanics of it, but
Mhm.
that's sort of a rough, summary. Now, in terms of how central banks redistribute wealth within society,
Mhm.
it can happen in a couple of ways. So, the one reason they get away with it is because people don't differentiate between cash, or between money and capital.
Mhm.
So two very different things, both very important. Capital is more important. So capital is anything that you produce, a good or a service. So bikes, which I'll give you an example in a second, or a massage, or whatever.
Mhm.
You're
Mhm.
producing capital. But money is simply the medium of exchange. It's used to exchange all that capital. So let's say you make a bike, I make a suit. We exchange those with each other. That's called direct
Mhm.
exchange, or barter. And now I've got your bike, you got my suit. But you can't have an economy of any size through direct exchange. It just doesn't work. So we have a medium of exchange called money. So you'll sell
Mhm.
your bike first, you'll get your money, and then you'll buy my suit. Now, let's say you make 10 bikes and they're $1,000 each, very nice bikes. You sell them, you got 10,000 bucks. You put
Mhm.
that $10,000 in the bank account because you're not gonna spend it right away. You're gonna, wait till the end of the year and go on a nice vacation. And so that $10,000 in your bank account, what that effectively represents is the 10 bikes that you produced. You're
Mhm.
temporarily storing the 10 bikes that you produced in that $10,000. That's what's giving it value. So now, let's say before you spend that $10,000, the central bank doubles the money supply. Now, when a central
Mhm.
bank doubles the money supply, they do not create any capital to obtain that money.
Mhm. Mhm.
They just print it or create it out of thin air. So it has no capital stored in it. It obtains capital as soon as it comes into the economy by extracting capital from the rest of the money already in
Mhm. Mhm.
existence. So as soon as it comes into the economy, it takes five of your bikes from your $10,000 and puts it into the new money, which somebody else gets. So
Mhm.
somebody else has got five of the bikes that you were storing in your $10,000, which means when you go to spend your $10,000, it will only buy half as much as it would have done before the central bank doubled the money supply, because it only stores half as much capital as it did before. And so it's inflation, of course. So now you
Mhm.
still got $10,000. You think you're doing okay. But now that really nice vacation you wanted to go on, instead of $10,000, it's $20,000. So you can only buy half a vacation.
Mhm.
One of you can go. Another way central banks redistribute wealth.
Sorry, if I could comment on that.
Yeah, of course. Yeah.
I have a question. Is it important who gets the money first when they print it, and where does it go usually?
Yeah. So those closest to the money, those who get it first benefit the most. And so finance industry, government spending. So when you get the money early, eventually that increased money supply is going to increase prices. But if you're one of the first ones to receive the money, you are able to go out and spend that money before it loses its value, before prices in the economy have adjusted. So let me give an example. So yeah, so when the central bank does quantitative easing, for
Mhm.
instance, they they're monetizing the debt. That's what they're doing. They say they're not because they do it indirectly. They use the banks as conduits, and they buy most of the, at least as of 2013, most of the assets that the Fed was buying through quantitative easing were from hedge funds or families, as they like to call them. There's a
Mm-hmm.
piece by Seth Carpenter, who worked at the Fed in 2013, which people can look up, and I cite it in my book. And so the hedge funds will sell the bonds to the bank and the primary dealers, and then they sell that to the Fed. Um, and and so so then the government issues all this debt, all this primary issuance, which the Fed is not allowed to buy. But as soon as the hedge funds get it, they just sell it to the primary dealers who sell it back to
Mm-hmm.
the Fed. So they are monetizing the debt. So now the government has all this extra money that it can go out and spend or send checks out to people. And those receiving the checks first, or however they're receiving the money, um, can buy stuff before the prices go up. If you're the last to receive the money, by the time you get it, the money has been devalued and prices have risen.
Mm-hmm. Right, so they give out money, and of course, just giving the money doesn't increase the prices, but the first people who spend it later on, that will create the inflation. And you also
Exactly.
talked about the budget deficit, because I know this great professor, and he likes to compare maybe stocks or like governments into personal finance so that it
Mhm.
is relatable to everyone. Could you
Yeah.
maybe use that to explain why there's a problem with this type of budget and how could that influence the monetary policy in short and long term?
Yeah. Yeah. So there are people out there who like to say that, comparing an individual's finances is not the same as finances as society as a whole. Yes, it is the same. The only because they say, well, governments, as long as they control their own monetary unit, as long
Mm-hmm.
as they create their own money, they can never default on the debt. Well, that's true only in name. It, they could not default on a debt because they can print as much money as they need to pay it off. But just like I said earlier, what matters is not the amount of money you have, is how much capital your money is storing. And every time they increase, so if they have to increase the money supply, if they have to print more money to pay off all this debt that they're taking on, they're extracting capital from everybody else in society. So there's no free lunch here. It comes at great cost. And then if governments are running up such high deficits that the debt starts to balloon like it is now, like Japan is crazy. But in the US, it's like 130%, something like that,
Mm-hmm.
debt to GDP. And now interest expense is over $1 trillion a year. And so then central banks are pressured by the government, as you're witnessing,
Mm-hmm.
to lower interest rates to make uh, the debt service more affordable. But like I said earlier, and Jim Grant talking about interest rates being the most important price in the economy, it's the regulator. It's a signal. It's capital markets, in order to function optimally, they cannot have the price discovery mechanism distorted, and it results in inefficient or suboptimal capital allocation. And it's happening because you've got players like the Fed who have no skin in the game. So the optimal or natural interest rate
Mm-hmm.
is that determined by market forces with skin in the game, those who've got something to lose and something to gain. And one of my favorite, or probably is my favorite line in economics, was by Ludwig von Mises. So the central banks have been distorting interest rates they call it the neutral rate. So the neutral rate is the rate that
Mm-hmm.
allows for economic growth without inflation. But because they've encouraged so much debt-fueled consumption and spending over the years,
Mm-hmm.
they have to keep lowering the interest rate to enable or allow the economy to grow. But neutral rate is being driven further and further below the natural rate, which results in the best allocation of capital. And so
Mhm.
Ludwig von Mises said that central banks can deny you the right to receive the natural rate of interest, but they cannot eliminate its existence. So the natural
Mhm.
or optimal rate is still there, but policymakers aren't allowing the market to operate at those natural rates. And thus you've seen productivity growth grind lower for decades and plus other consequences which we can talk about.
Mhm. And I also wanted to ask you about global trends connected to gold and silver. Do you think that the world is moving away from US dollar and moving into precious metals?
Well, yeah, the world definitely is. And I was just writing about this. I have a free blog as well. It's a weekly blog, and I was just writing about it this morning. And how, countries, especially like China, has significantly reduced their holdings of U.S. Treasuries over the last 3 years, and others have as well as they become worried about the U.S. sort of weaponizing the dollar, and and of course with the monumental amount of debt and money supply increases that are happening in developed economy. And so I have some gold in my portfolio. I view it more as a hedge than an investment. So
Mm-hmm.
it's a hedge again. Well, I call it my central bank lunacy hedge. And you'll hear a lot of people say, well, with all the debt outstanding, there's no way we can pay it off. And you don't have to pay it off, by the way. You just have to stop
Mm-hmm.
growing it. And the only way out is we'll have to resort to financial repression. Like this is an okay strategy. No, it's not. Financial repression is terrible. And if they do that, the price of gold will do extremely well in the following years. Now, ironically, if they finally decide to do the right thing and stop abusing the fiat currency system, there's nothing wrong with the fiat currency system other than it's so easily abused. So if they decided to resort to a hard money, then which would be very good, by the way, initially be very painful, but that would not be good for the price of gold, unless they decided to go to a gold standard,
Mm-hmm.
hard money that way, and then that would be good for gold. So that's the way I view gold. I don't own any silver, not because I think it's not a good idea. I just don't know enough about silver,
Mm-hmm.
and so I just try to keep it simple.
That's very wise. And what do you think about the recent price performance of gold and silver? Because silver, for instance, it rose 200%, even more last year. Do you think, because you're optimistic about gold, but do you think this is the a good time to invest?
Yeah, I have no idea. I mean, it's as an investor,
Mm-hmm.
investing is a very humbling business. And, everybody thinks they know what's going to happen or think they're smarter than everybody else or look for others who have an opinion. And you can go out there and find two extremely smart and experienced people who have two completely different views on what will happen. And both sound, you know, that they could happen, And and part of it will, be dependent on geopolitical events, which are also extremely difficult to predict.
Mm-hmm.
And it's also difficult to predict how markets will respond to these geopolitical events you can't predict. It might make sense that this will happen, but then something totally different can happen that you never thought of. And so, I used to try and figure these out when I was younger.
Mm-hmm.
And I just thought, you know what? I was just trying to prove to myself that I could figure it out, and it was coming at the expense of my clients. And so I just said, I'm not going to do that anymore. And I'm just going to keep things simple, invest in what we think we can predict, and that is human actions, management behavior of the businesses in which we're investing, which we can talk about if you want.
Hmm. So personally, I think that we cannot predict the future for a certain. However, we can judge where we are right now. And um, statistically speaking, if the silver or gold have an average yearly return of about 6%, and in last year we see a rise of more than 200% connected with high optimism on the market, on average, maybe new investor, that might look like a good opportunity due to them making this basic error and investing because something is often on the news, because the price is appreciating, and that it gives them negative emotions in terms of investing, which is greed most often.
Well, yeah, no, that's very true. And the industry I worked in, the mutual fund industry, I mean, we're infamous for selling performance
Mm-hmm.
or marketing performance, I should say. And the problem with marketing performance is just like you just said, you can only market the performance after it's happened.
Mm-hmm.
So, if you're marketing a certain mutual fund, let's say it's a deep value style or it's a momentum style or growth or quality, whatever, and it's had great performance for 3 to 5 years, well, that's when the companies will go out and start marketing that mutual fund, but the performance has already happened.
Mm-hmm.
And the market might be moving to a different phase or a different style or a different part of the cycle or whatever. And so you often have, not often, I would argue always, that when you look through a cycle, the client outcomes within mutual funds are worse than the dollar weighted outcomes are worse than the time weighted outcomes. So the client outcomes are worse than the fund itself. And it's tough to change that because mutual fund companies sell performance because that's often what people want to buy. And yeah, it's a tough nut to crack.
I also wanted to ask you about your investing philosophy. How you find quality and what, in your opinion, is more important, quality or price?
What was the last part there? Sorry.
What is, in your opinion, more important, quality of a business or price
Oh,
of the business on the stock market?
yeah. So they're both important, obviously. Um, I think the quality is more important. But let me define quality first, at least from
Mm-hmm.
our perspective. So, a quality company for us was a business or is a business that focuses on the customer first, that has some sort of competitive advantage that you can identify. I mean, and if you put your mind to it and you look at the business and you do some research, you can usually figure out what the competitive edge is. It's not always obvious, but usually it is if you put your mind to it.
Mm-hmm.
But that's not the hard part. The hard part is having confidence with respect to the sustainability of whatever that competitive edge is.
Mm.
And for that, you look at the corporate culture of the business, look at the accounting of the business. The accounting can tell you a lot about the personality of management
Mm-hmm.
because there's latitude within accrual accounting. So different choices that management can make. And so what you would want to see, you'd want to see a business that it has conservative accounting. You want to see a business that has a conservative balance sheet. They don't have too much debt. I used to run a European fund and it was very concentrated, 20 businesses, and half of them didn't have any debt at all.
Mm.
And after the great financial crisis in 2009, 2010, it was by far the best performing European mutual fund in Canada.
Mm-hmm.
Despite the fact we had companies that weren't, taking on more risk to try and shoot the lights out. So And you want another thing to look for. You want companies that are reinvesting in the customer, reinvesting in the business, and not investing in their share price. So you want
Mm,
to see businesses that are continuously looking for ways of giving more value to their customers, wow them even more innovative products, rather than just trying to increase the price for the same product. If you're just increasing the price for the same product, you're diminishing the customer value proposition and you open the door to competition. And eventually your business model can be in big trouble. But for companies to do this, they have to have a long-term mindset. Because if you
mm,
have a short-term mindset, you can extract value from the customer and make more money. You can reduce investment in capex and R&D and improve your profit margin. You can, yeah, increase the price of your products or whatever, drive sales higher, take on debt, buy back your shares, destroy your balance sheet. These
mm,
things are all good for your share price in the short term, but longer term, the business suffers. And so that's what defines quality for us. And often one of the differentiators is that quality companies have more of an entrepreneurial spirit. So, like if you're a founder of a business, you've pretty much done every job there is in that company. And so you have a lot more empathy for what your workers are going through because you've been there and you love the business. And there's one example I use in the book, a company called Fastenal, based in Minnesota, and
mhm,
pretty basic business. They distribute fasteners, screws, and stuff like that. And when we toured their plant, the employees were so excited. They loved the company, and I asked them why, and they said, "Well, management, ownership, they treat us so well. They listen to what we have to say, and we all share in the success of the business. That's really key. It's not, it can't just be senior execs and the shareholders. It's also got to be suppliers, employees, society at large, and the customer." And so the guy said, "Yeah, we all share in the success of the business." Oh, and here's another example. The CEO, who was the founder, owned about a third of the company. His wife owned a good stake as well. She had passed away, and the CEO took all of her shares and
mm,
distributed them to all the employees in the company. Right? This is
mhm,
capitalism, by the way. Right?
mhm,
And so this is a sustainable business model and a good business model. And so now, to your point about comparing or what's more important, price or quality, you could have a very high quality company like Fastenal, but
mhm,
if it's overpriced, it's not a good stock. You have to differentiate
mhm.
as an investor, you have to differentiate between a business and its share price. Now, having said that, I believe that if you have a high quality business, that if you make a mistake by paying too much for it,
Mhm,
the high quality nature of that business over time can get you one side.
mhm.
It might
It
have
will
to wait a
catch you
little
up.
bit long, you know. But if you make a mistake on the business
Mhm,
that's not high quality, but you buy it cheap, then that has less likelihood of working out. Now, only assumes that you are thinking that it's quality. You can have lower quality businesses that end up being really great investments. And these are
mhm.
deep value investors, of course. It's a completely different investment style, but it's a good style.
Our interview is coming to an end. Could you please share where our audience can find you?
Sure. So my I have a website. It's called there's Paddington Capital MGMT.com. And on there I've got all my free blogs or posts from the last few years. I've got interviews like this on there. And my book is called Capital Offense: Why Some Benefit at Your Expense. It's written in very easy to understand terms. I've sort of cut some corners here in this talk, but step by step, lots of analogies.
Mhm,
So it's online, Amazon, Barnes and Noble, in the UK, and WH Smith, stuff like that. It's also on Audible. So for those who prefer to listen to their books rather than read, they can access it that way.
All right, that's something for me. I prefer to listen. All right, so
Okay.
thank you
Okay.
very
Yeah.
much. And yeah, that's everything for today.